There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, Auvorians, to the weekend software strategy session. My name is Steve Federal. I act in hopefully a quality research, macro, risk management type capacity. Try to do these calls a little bit after 10 a.m. on Tuesdays, 1 p.m. Eastern time on, wait, that made no sense, right? I try to do these calls at 1 p.m. on Tuesday, or a little bit thereafter. Same thing on Saturday morning, but at 10 a.m. So I have talked, I would say, probably over the last 6 to 8 sessions exhaustively about macro. I'm going to do you guys all a favor today. I'm going to skip it all. So let's get right into the action. Always with Forex Factor, you want to make sure you forward to the next week's date. Don't be talking about last week when it's next week. Any case, so Monday, 0. Tuesday, all kinds of PMI, right? So Purchasing Managers Index coming out from basically everywhere. So this should be interesting. I would actually, for once, take a closer look at this. Maybe at the end of the day on Tuesday, I would avoid trading around anything red folder based. Why? Because we just don't know, especially the impact it could have on currencies, even though they seem to be sleepy. Trust me, they could wake up and roar at any given time. Now, next week is the big prom. We used to call it the prom. Anytime you get together, any kind of corporate event where you hand out awards, we call it the annual prom. We used to do it a lot. And at the prom this year, which is really called the Jackson Hole Symposium, it is a multi-factor grouping. You can click on the box here if you want to see more about it, but essentially it's a policy symposium. So before the pandemic, most of the central bankers would show up at Jackson Hole and they'd take some great pictures. It's actually a really good picture out there of Janet Yellen, Mario Draghi, and I think it was the Japanese central banker at the time. I forget. It was actually a really good picture, and the looks in their faces were just like, my God, we can't believe we have, the world money supply in our hands collectively, right? So the anticipation that Jackson Hole, the keynote, which is obviously kicks most of it off, will showcase the inflation fighting resolve. Should it depress equities in the coming days? It's really only a dream. So this is a 2-day event. I'm not going to tell you not to trade all day Thursday and Friday, but let's face it, anything could come out of this. So if there's ever a time to be cautious, maybe take a quarter size, maybe take half size in trades during this period of time, maybe take no size. Remember, sitting on your hands is a position, right? It's called cash, right? And it is a capital preservation position. It is nothing to be unhappy about. It is nothing to be let your hearts not be troubled about. It can be a wise position to be in. So that's the news. S&P. First reversal we've seen of any magnitude off of the high. And price just adjusted itself. That's always kind of strange on the weekends. It's almost like there's like a little bit of energy still left in a market that's actually closed. All right, so for those of you trading anything S&P based, as I talked about this midweek, up against a huge moving average line, top of Bollinger Bands, Keltner channels, however you want to dial in any types of sort of stretch of move, we're there. So just understand that with reversals, not abnormal. Big area, no surprise. Put any lines on a market profile. You put, actually notice we got some missing notches right in here. So I would say we're completing the auctioning process here with this gap you see here with a little plus sign on the left-hand side of the screen, filling in what was to be probably a bigger crevice, if you will, in volume. Typically that's called missing notches. It's just a sophisticated way in market profile land to say that you are needing probably more time to auction inside there to build more volume, because volume is built on the two previous peaks and not in the valley, right? Doesn't really mean anything in the very short term. In the long term, it just means you probably have more auctioning to go. So I'm not going to get too into this, but I think this 4174-ish area, which is about 50 points lower, it's probably where we'll land before we start moving sideways again. Notice I really don't show other markets. I do not like the Dow. Yes, I know some of you trade the Dow 30. I get it. I just think it's an inefficient benchmark to do any analysis on it. Don't do it. Let's go to the dollar. Back up near the highs. No surprise. I said the squeeze zones, especially when an orange color pops up, shows typically strength in support. Bounce off that level. Once you bounce off of, have a pretty decent reversal, what happens in typical auctioning process? You'll go back up towards the high of this area. Correspondingly, euro back down near par. I actually saw some prices of stuff I was looking to buy in Europe on eBay, right? Mostly just car parts are hard to find here. And it was actually a fairly decent currency exchange. I was almost getting $1 for $1 on these parts I was buying. It's crazy. So from the standpoint of just my own selfish automotive car purchasing needs, getting a better deal. Pound back near the lows. This is probably one more of those surprising moves. And keep in mind, we're looking at daily charts. Each of these candles represents a single day. Back near the lows. We should hold here. We hold here and we hold the highs of the dollar. You're going to have the double bottomers and the double toppers coming in to the discussion. These are typically reversal patterns. If they hold, this is a strong area, just like obviously the high in the dollar is. Anything between this area is anyone's game. The extreme outs would be somewhere around the touch of this bottom Bollinger Band, which is that one spot in 1728 area. Dollar Canadian, again, reversal, typically tells you auctioning prices are going to want to move back towards the range high. You know, if you were to call this a value area low, which I have no meaning to say that, but if this was the value area low and the value area high, which typically represents about 70% of the median volume internally of what trades in the aggregate, normal market profile principles will tell you if you can't break below, oftentimes you're going to travel to the other side to auction prices higher to see if there's any continued buyers up there that may be lifting the offer price higher. Okay. Dollar yen, not going to get into it too much. Still inside the range. Aussie US dollar. Canadian Swiss, CAD JPY. See these all defined ranges we're still in here. Again, anything could fall off or bust out if there's any craziness at Jackson Hole later the next week. Thursday and Friday. Euro yen. Euro CAD. Notice the very tight range that it has had at the bottom, right? Is it a coiling move? Can't tell you. Could be. I think a lot of other things, a lot to happen in other pin action, if you will, off of other currency pairs in order for any of that potential energy or trading volume to reverberate inside of this other major. Euro GBP, strength in Euro. Euro AUD, I don't really show this chart this much. GBP CAD, we obviously show this a lot. We take a look at a Marauder. Look at that, right back down towards the lows. Surprising weakness in the pound. Look, they got a lot of problems. There's reasons that the dollar could be worth a lot less as well, right? We have all kinds of problems, including a build back crappier bill that was passed is probably just a giant piece of shit, but we'll see. It's agitating your policymakers in DC. Can't get anything done, but battle that out over media, camera attention, and I'll skip the diatribe for everybody's purposes today. Many things to say on that front, but I will spare the gold. It's the GLD. I prefer looking at spot 1800 so far. Pretty solid resistance. The lesson to be learned on this one, even if you're not trading gold, it's all about candle and technical analysis based lessons, right? When you have big vol ripping through a huge area, this is what you call a zipper move, meaning it just tears through all kinds of what's typically a large somebody dumping a chunk, right? We don't have the volume overlaid here, but you can probably jump back to GLD and see, big vol here. It oftentimes will signal even though there's really nothing there, honestly, other than just a century mark. It'll oftentimes signal a other time frame player, right? Institution, sovereign wealth fund, mutual fund, hedge fund, you name it, right? Any kind of big player, bank, you name it. We just call them OTFers. We don't have to get into the weeds on who's who, because quite frankly, we don't know. We know that there are other time frame players, meaning they don't care about 5, 10, 30, 60-minute charts. They don't care about 240s. They don't care about Renkos or any of that crap. They are up there for now defending this area. You can see it right here. So anytime you have some sort of zipper through move, especially if it's a company with large vol, let's double check that instead of me just talking blind here. Let's jump back to GLD where we can see vol. And there's the large vol I was talking about. So if you stretch this out, it's kind of tough to see. Remember, this is just a GLD, which mirrors the spot market typically. See how we gapped through and had 2 days of one time framing down, meaning it was a protracted zipper-based move, accompanied by volume. Oftentimes the scene of the crime, which, by the way, this is an excellent example of a slingshot, right? Your stop would be like right here on this trade. 168.53 to reload the boat. Even if you had reloaded the boat on our first zap up into this area, you'd have made money. See right here? But it's typically the first couple of slingshots finally getting a little bit long in the tooth, but obviously the dollar started ripping, so this started pulling back. All these crazy uncorrelated based trades these days. But the cool thing about that is, I always like to illustrate the lowest risk trade out there is it's what's called slingshot. And it's a rip back into whatever confluence areas of a first start of a trend. If executed correctly, depending on the market, this is a generalized statement, you have win rates in the mid 60s to higher on those types of trades if it sets up correctly and is the first shot into that area. Everybody will call it different things. I call it a slingshot. All right, spare the individual equity rhetoric today. Coinage. Back down against key points. We were having a discussion last night, as many will probably, as children, find the macroeconomics and buy and sell discussions I'm having with my children who are in the heat of their teen years, and I think are ready for a portfolio management slash. I actually gave them those 2 books I showed you guys for our summer reading list. So they're getting a little better at understanding supply and demand. Here's an example of, which is probably they like to call these guys whales with laser eyes. Somebody's dumping here. So we're holding his usual center point of previous zone. See that? It's also the point of control. Why? Here's the aggregated volume on the left center point, or the highest point of volume, is called a POC. Notice how that held us, at least for now. So technical analysis and market profile based and general analysis of that type of trading is beginning to put more weight in these charts. What does that mean? It means that you can put more, what's the word I'm looking for? Solidity? I don't know. Maybe that's not a good word. You could put more oomph in it as an indicator because it's starting to act like it should. Doesn't mean it will in the future, right? Support. It's like right around 19,000 a coin. High was 25,240. We're in the center point of the lowest zone. Absolutely would have to hold, even in a whipsaw. You really wouldn't want to see. Ideally, if you truly want to buy what's called an extreme out, as long as we weren't one time framing into this area, right? Because that means it was dangerous, exceptionally sharp knife falling because we were one time framing down, right? Remember, the one time frame, it can always apply to more than just these daily charts, right? It can apply to a 5 minute, 15. I don't know, you want to go much lower than that. And if a particular anything that's trading is pushed in 3 or 4 candles that completely print outside of each other and zipper up or down into an area, it's typically tough to try and get in on that, because as the freight train or the whatever train, the bullet train, is ripping through the train station, you're trying to grab onto the end of it as you're tearing through it, and more likely going to fall if you get run over in the tracks, right? It's much easier to just get on a slingshot than it is trying to tear into something like this. But for those looking to sift through the ashes, as I often was teach my kids about waiting for asset prices to come down in a given area, could take a year or 2, you have to be patient. Sifting through the ashes has yielded good results, unless you've been short all the way down on this, in which case you've done much better. But this 18-1 area, it's the edge of the cliff. Everybody, have a great weekend. Told you I cut right through the crap. No more mindless Steve opinions on stuff this weekend, because quite frankly, in the grand scheme of things, it doesn't matter, right? So learn to do your own research is my ending advice for the weekend. You can use any of the gurus you follow. I look at myself as I'm not your guru, right? I'm just a guy trying to help you understand the macro markets out there and how things trade and do better. Most importantly, to recognize risk, which exists in everything. So weigh your options carefully. Make sure you think through your choices. I don't care if it's buying a couch or if it's trading a commodity or a Forex, right? Choosing a software for that matter. Always think through what can go wrong, right? And if it does go wrong, are you protected? Have you put the right, let's just say, stuff in place to protect yourself? With that, everybody, I will wish you a great and safe weekend. Give everybody a hug. I'll see you on Tuesday.